Okay, good morning, everyone. Thank you for joining us today for bi-weekly seminar today. Before we begin, I'd just like to inform everyone that the webinar will be changing to a weekly format from August onwards. And if the webinar happens to fall on a public holiday on a Monday, it will be pushed to the following working day unless otherwise stated. But no worries, we will be reminding you guys again subsequently. Okay, so for today, we have quite a bit of ground to cover. We have SATS latest quarter update, 3 stock initiations, the ESR Sabana REIT merger update, our REITs monthly, and SG weekly update. So without further ado, let us begin with our first initiation with Hyphens Pharma. So for Hyphens Pharma, we are initiating coverage on the counter with an accumulate call at a target price of 43.5 cents. So a brief company background. The company was listed on SGX in 2018, and its principal business includes the sales, marketing, and distribution of pharmaceutical and healthcare related products, with revenues being classified under 3 business segments: the specialty pharma, proprietary brands, as well as the medical hypermart and digital. So in terms of geographical footprint, Hyphens Pharma operate in 5 primary markets: Singapore, Vietnam, Malaysia, Indonesia, and Philippines, and have marketing and distribution presence in 6 other smaller geographies. So before we try to understand the company's business model, let us take a look at the industry value chain for pharmaceutical and medical goods. So within the system, on the screen, you can see the graph itself. Within the system, we have 5 main stakeholders that bring a product from conception to consumption. So we have the brand principals, the manufacturers, distributors, wholesalers, and the customers. The relationship is highlighted in the chart as shown on screen, with each party undertaking the business functions marked out by the blue boxes. So brand principals are people who create the products by undertaking like R&D activities, and after a product is successfully created, they can actually bring the product to market directly, as shown by the red arrow. Or actually, they can go through a distributor which assists with the sales and marketing activities that is often required because these distributors usually have the regional know-how to sell these products, as they typically work in specific markets. Then these distributors can further work with wholesalers to bring the product to customers, which usually include specialists, general practitioners, retail pharmacies, and even hospitals. We need to note that this relationship is only for one product. So within the entire pharmaceutical industry, because of its fragmented nature across different product class, with each medical discipline comprising its own subsegment. So for example, dermatology itself is one, orthopedic itself is another one. We see that the actual relationship between the entire value chain becomes even more complicated, and the lines between each party can become blurred. And that's why we want to try and see where Hyphens Pharma fits within this value chain itself. Okay, so on screen now, I have actually classified Hyphens Pharma and its business segments into the value chain itself through the 3 different business segments that they operate. So as a distributor, you can see that Hyphens Pharma carries products from 2 of its business segments, proprietary brands as well as specialty pharma, and distribute to its customers in the various geographical markets. So proprietary brands include dermatological brand Ceradan and TDF, as well as their health supplements, the Ocean Health, so which the company actually undertakes R&D activities. For specialty pharma, Hyphens enter into exclusive licensing agreements with the brand principals to distribute within the region, meaning that no one else within the region will be able to sell the same products as them. However, that is not all the products they carry. Through its business segment in medical hypermart, Hyphens Pharma also carries many other products from brands such as Pfizer, Sanofi, and GSK, and sell it to customers in Singapore. So this is important because the medical hypermart becomes a one-stop shop for a lot of customers in Singapore. Like I said, the pharmacies, hospitals, GPs, and specialists, to get all their medical supplies and pharmaceutical goods. So with this strong presence across the entire value chain, the business that Hyphens Pharma operate in is very integrated, and Hyphens Pharma can focus on the high-value activities such as sales and marketing, while outsourcing some capital-intensive activities such as manufacturing and the physical distribution of goods out to the third parties. So for the reasons we like Hyphens Pharma is as follows. Firstly, there is a high loyalty to products within the specialty pharma and proprietary brand segment. So being the product owner and having exclusive distributorship within the region, it allows Hyphens to build following from customers. And when their customers are discerning medical practitioners, it takes a lot of convincing to actually achieve the final product sell-through. But because of their successful sales and marketing activities to conduct education and product training, Hyphens Pharma has built up a strong customer base that is familiar with their products that they carry and makes it hard for them to switch to other competing products as well. Secondly is for their expanding retail presence through online and offline channels. So traditionally, Hyphens Pharma operate on a B2B business model, meaning that their customers are like clinics, hospitals, and pharmacies. But with the acquisition of Ocean Health in 2016, Hyphens Pharma actually managed to secure other downstream sales channels directly to the retail market. As such, we have seen that in the second half of 2019 itself, Hyphens actually brought additional products to the market like Ceradan and Sterima and Vivomix, which were already in the market, through the retail pharmacies such as Guardian and Watsons. And additionally, they also expanded into online sales channel in Lazada, RedMart, and other e-commerce platforms, which will help boost revenue subsequently. Lastly, their strong presence, as seen by the value chain diagram I showed previously, shows that Hyphens Pharma is able to create value through their high-value activities while outsourcing the more capital-intensive activities. So some risks will include their dependence on relationship with brand principals for their specialty pharma portfolio, and delayed product registration and renewals. So yeah, that they can prevent loss of demand, and also from the competition from other brand principals for their proprietary brands portfolio. However, how they Hyphens actually come up with mitigation actions that can help to reduce the risk. So for the dependence on relationship, we have seen that Hyphens Pharma has built up long-standing working relationship with brand principals, meaning that brand principals have lesser propensity to switch distributors. So for delayed product registrations and renewals, Hyphens Pharma actually works with supply chain partners very closely to manage inventory levels to ensure that the supply levels are sufficient to meet demand, even during the downtime, preventing a loss of sales and demand. So lastly, for the competition within its brand portfolio, Hyphens Pharma have protected its technology through patents of its therapeutic treatments, such as the recent grant of the Ceradan Advanced Patent in the UK, which can set its product aside from other competitors. So to take a look at the financial highlights and our forecast briefly, for revenue, we are expecting robust growth over the next 3 years of about 10% year-on-year due to the positive outlook in the growth and expansion of Hyphens Pharma's product portfolio within the specialty pharma and proprietary brand segment. And while the product margins should get higher as contribution from these higher margin products within the proprietary brands and specialty pharma goes up, what we are doing is we are holding the gross profit margin steady over the next 3 years. And in terms of dividends, Hyphens Pharma distributed 1 cent per share for financial year 2019, which represents a 2 to 2.5% yield. So moving forward, they are looking to distribute 30% of their net profit as dividends, which leads us to believe that the current dividend, the distribution rate will be sustainable. So for valuation-wise, we have used the discounted cash flow model with weighted average cost of capital of 7.2% and a terminal growth rate of 1.5%, and reiterate our accumulate call with a target price of 43.5 cents. So for more details to the full report, please visit Stocks BNB. Thank you. So now moving on to Jie Hui, who will be talking about the merger of ESR REIT and Sabana Sharia.
Hi, thanks, Yu Guang. I'll be presenting on the ESR Sabana merger today. And just a disclaimer, we do not cover ESR REIT or Sabana REIT. Some details about the merger. The proposed merger solidifies ESR REIT's position as the 5th largest industrial S-REIT. Post-merger, Sabana will become the wholly owned subtrust of ESR REIT, and the merger is expected to be completed in 4Q20. The total acquisition cost on ESR REIT's end will be in the form of consideration units, new debt, as well as acquisition fee in units. The implied scheme consideration is 37.7 cents per Sabana unit at a gross exchange ratio of 0.94 times. This is equivalent to approximately 990 million new shares issued for Sabana units. Additionally, ESR will refinance Sabana REIT's borrowings, interest rate swaps, upfront land premium, as well as professional fees in new debt. The acquisition fee will be paid in 20.7 million ESR units to the ESR REIT manager for the merger based on an illustrative issue price of 40.1 cents. From the chart on the right, you can see the details of the proposed REIT pre and post merger. Of the proposed merger, pre and post merger. So post merger, ESR REIT's number of properties grew by 31%. AUM grew by 28%. Market cap is also expected to increase to 1.8 billion, which increases the probability of inclusion into key indices. There will be a DPU accretion of 3.5% and an NAV accretion of 5.2% for ESR unit holders, as well as a 12.9% DPU accretion for Sabana unit holders according to the proposed distributable income. In terms of shareholdings, we also see a consolidation in the key stakeholders of the individual REITs. So you can see from the table, ESR Cayman and Mr. Tong hold 9% and 23% respectively in ESR, while holding 21% and 3% in Sabana REIT. Post-merger, ESR Cayman and Mr. Tong will hold 12% and 18% of the enlarged REIT, as ESR Cayman and Mr. Tong holds 67% and 25% respectively in the ESR REIT manager. We see an alignment of interest between the sponsor, ESR REIT manager, as well as the unit holders. Lastly, some benefits to the merger. The enlarged REIT will see a greater exposure in high specs and logistics segments, as well as reduced concentration in top 10 tenants from 31% to 25% of GRI, gross rental income. And there will be a greater presence in key industrial clusters, as well as an increase in organic growth opportunities from the additional 1.2 million unutilized GFA from Sabana. Cost of debt will also be lowered for the enlarged REIT by 25 bps with a longer average debt expiry. Yeah, so that's all for the merger. I'll be moving on to our initiation. Thanks. Okay, so we are initiating on Manulife US REIT and Prime US REIT today, and I'll start off with talking more about the US office sector. The US economy faced a rough start to 2020 as the year opened with COVID. In the near term, the pandemic has resulted in fewer workers in the office. We believe that working from home is not a permanent solution it's not a permanent solution that can replace physical office materially. We have a few reasons as to why we like the US office REITs. Yeah, okay, so firstly, we like that the US office sector offers superior yield play. In this economic climate, where interest rates globally are depressed, US office REITs present attractive yield spreads of 7 to 9% to the US 10-year Treasury yields. The yields of SG listed US office REITs also outperform that of both Singapore office REITs as well as US listed US office REITs by 1.7 times. We believe that collaborative work in a dynamic environment will hold demand for office, coupled with long WALEs to support. Although COVID has accelerated trends like remote working as well as telecommuting, the US has employed a substantial percentage of remote working even pre-COVID. According to Gensler, office work has evolved from an individualistic mode to one that is more collaborative. So in from 2013 to 2016, from 2016 to 2019, we can actually see that employees have spent 14 to 15% of their time telecommuting. But in the same time frame, we also saw rental growth and declining vacancies in the office. This highlights that telecommuting and office, they are not mutually exclusive. Employees do see merits in a dynamic working environment, which leads to mixed responses in view of their need for office in the next 3 years. If you see from the table on the left, 30% of the respondents feel that less space is needed, while 70% have the view that it's either going to stay the same or it has to be more. Coupled with long WALEs, the income stream for office REITs is usually predictable for 5 to 10 years into the future. So if you can see from the chart on the right, 94% of the larger office leases will only start to expire 4 years from now, which suggests that landlords do have the time to adjust to the future of work, according to Moody's. Office using jobs are less affected by unemployment, and we are looking forward to a stabilized normal. Amidst the outbreak, the unemployment rate surged to a peak of 14.7% in April before declining to 11.2% in June, which is higher than the peak of 10% during the 2008 GFC. While the economic data paints a gloomy outlook, the unemployment rates for the heavyweight anchors industries in the office, like financial, professional services, as well as business services in June, was the lowest and third lowest amongst the industries. Using 2008 global financial crisis as a recent crisis proxy, business formations in the US grew at CAGR of 4% over 10 years as the US economy recovered. Lastly, office space demand by top 3 leasing drivers like tech, financial, and professional services will moderate. These pillars of the economy have a long heritage of defining how they do business. Telecommuting telecommuting predates COVID, but the fact that these sectors still choose to conduct certain elements of the business in the office implies that these sectors are best served by the office premise. We believe that structural shifts in the office landscape will be more gradual rather than immediate, with the desire for physical collaboration and networking, resulting in the maintenance of an office address. Some risks to the sectors are as follows. Telecommuting has heightened the possibility of companies moving towards a more premise-like business model. Additionally, consolidation and downsizing within industries may lead to greater shadow market space should current tenants be allowed to sublet their space. Held together, this points towards a softer leasing environment. Leasing activity fell by 18% quarter-on-quarter and 14% year-on-year as businesses take on a more cautious approach towards relocations and expansions. Rental growth is expected to remain weak as the landlord's pricing power is highly reliant on demand for office space, which is at the mercy of its markets and its market's employment growth as well as economic health. Yeah, so moving into the stock counters, just a bit of background. Prime US REIT primarily invest in office and real estate assets in the US. Prime portfolio consists of 12 Class A freehold office properties that are valued at approximately 1.4 billion, strategically located in 10 primary markets. We like the REIT for the following reasons. Firstly, the REIT offers attractive dividend yields at 8.9% in FY20, which is higher than 8%, which is 8% higher than that of US Treasury yields. In this economic climate, Prime is currently trading at 0.86 times by price to NAV. Our forward dividend yield for Prime in FY20 and FY21 is 8.9% and 9.5% respectively. Prime has resilient portfolio attributes. Income visibility and stability is supported by a long WALE of 4.9 years, which only 5.7% of the leases are expiring in FY20. These expiries are also well staggered with a maximum of 17.3% of leases expiring in the next 4 years. With no market and sector contribution exceeding 13.4% and 15% respectively, Prime offers high levels of diversification in terms of its market, asset, and tenant mix. Additionally, all of Prime properties are Class A buildings, and we believe that a high quality and diversified office portfolio offers more resilience in times of uncertainty. Approximately 98% of the leases have inbuilt rental escalations of 1 to 3%, which provides a clear organic outlook for the REIT. To top it off, the leases expiring in FY20 and 21 are leased at an average of 7% below market. Hence, there may be potential reversions which will drive rental and distributable income. Prime has a robust balance sheet. As of 1Q20, Prime continues to maintain its gearing ratio at a healthy level of 33.7% and interest coverage ratio of 5.8 times. There will be no refinancing required until 2024 as extension options are available to extend both loans that are maturing in FY22 and 23. Near-term interest rates are also mitigated as close to 89% of the debt is locked into fixed interest rates. And separately, Prime restructured its existing interest rate swaps by entering into new agreements on its borrowing through 2026. It lowers the weighted average interest rate for the portfolio from 3.3% to 2.8%. Prime also has an efficient REIT structure. Prime's headline tax expenses mostly reflect deferred tax expense, which will only be recognized upon sale of the properties in the portfolio. This reduces cash taxes payable, which results in more distributable income for the unitholders. Additionally, Prime's REIT structure has no tax leakage through federal income or withholding tax, provided that unitholders comply and furnish the required documents for portfolio interest exemption. Lastly, Prime has a reputable sponsor and management team that is associated with one of the largest US commercial real estate managers. Associated with KBS, KBS Asia Partners is the sponsor of Prime. KAP for short owns 40% of Prime's manager, which is KBS US Prime Property Management. KBS affiliated entities invest in and manage commercial real estate on behalf of its clients, and to date, KBS has registered 41.7 billion worth of transactional volume with over 8 billion worth of AUM since inception. KBS has presence in all the states that Prime has presence in. So given that KBS has successfully managed properties through 4 disruptive events, its expertise and track record presents more value to Prime's organic growth potential through troubled times. Separately, Prime will also be able to benefit from KBS deal sourcing, screening, as well as execution capabilities for inorganic growth opportunities. Okay, so just an update on COVID-19. Rent collections for May and June are at 99%, with June's collections on track. Most of Prime's leases do not have pre-termination clauses, so tenants are obliged to compensate till their leases expire in case of a lease break. As of date, only 11 rental deferments are provided to small retail tenants, which contribute less than 1% of the GRI. These businesses are amenities to the building. Majority of the rent deferrals are expected to be recouped this and next year, while the remaining deferrals will included lease extensions, which are equivalent to the number of months rent that was deferred. Apart from Sodexo, Apache, and WeWork, majority of Prime's top 10 tenants are established tenants. All of Prime's top 25 tenants, which constitute 64% by CRI, has paid 100% of April and May's rent. And amidst uncertainty in the outlook for co-working spaces, it may comfort investors to know that the rents from all the co-working entities like WeWork and 3 smaller operators have been collected. Okay, so last slide for me. In terms of key risks, we expect recent activities to weaken as businesses are impacted by the recent escalation of events from COVID, while at least half of Prime's expiring leases, which is 5.7% of the GRI, are expected to be renewed. Greater investor caution and selectivity coupled with lockdown inconveniences will increase the time to close new leases. Co-working tenants are also expected to be hit hard by the outbreak due to their focus on short-term leases as well as a reliance on users coming into the office. Demand for co-working spaces is expected to remain soft, which poses uncertainty to Prime's income stream. Nevertheless, the total proportion of co-working spaces in the portfolio is only 3.7%. Initiate coverage on Prime US REIT with a buy and a target price of 88 cents. Our DDM derived target price is based on a 5-year projection, cost of equity of 9.96% and a terminal growth rate of 2%. It translates to a total dividend yield of 8.9% in FY20 and a total return of 24%. In our models, we estimated a 1 to 3% annual escalation rate for the leases. In light of a lackluster leasing environment going forward, we accounted for a 5% impact to NPI through an increase in property expenses as well as a 50% renewal rate for expiring leases in FY20. Now I'll be moving on to Ned, who will talk to you more about the Manulife initiation.
Yeah, thanks. Okay, as we wait for Mthly, let me just this Paul here. Let me just run through the SATS results. It was a little okay. Anyway, the first point, if you look at the PATMI, it was a loss of 6.3 million. I think in their guidance or profit guidance or maybe profit warning, they were looking at 15 to 20 million. So this is below the guidance. They made some write-offs. Even the associates, there were some write-offs. I think the details are there. You can see but do note that even they still make there is a 21 million government grant, your JSS ang pao in a way. So it's almost like 10 million per month. Okay, and let's move on to the positives. The positive that they did make aggressive cost cuts. I think excluding the government grant, they still managed to lower their cost by 16%. So and which is faster than revenue falling 8%. So that helps. And they also mentioned in the call that they are enjoying some additional revenues. But obviously, some are one-offs. You know, some of it was the cruise centers where you need to house some of the foreign workers. You need to help provide food and so forth. The other one is, you know, as the mushrooming of all these cloud kitchens, you know, online takeaways, and that's another source. But in general, these are either one-offs or not very large. The negatives, of course, you know, usually in the final quarter last year they paid 13 cents dividend. So this quarter there is no dividend, so you can forget about the 13 cents. Okay, in terms of the outlook, one thing to note is also they're going to close their in-flight catering, which is, you know, in Changi they have 2 in-flight catering centers, so they're going to close one. Okay, anyway, we downgrade to sell. Why our recommendation? The main thing is that we have no visibility. No visibility of how steep the recovery will be, or even how long. Just to give you some gauge, which I think the management has also agreed, is the IATA forecast. You know, IATA is is the international organization for all the airlines. So what they're looking for is 2023, a full recovery to 2019. Of course, if you have the patience, you can wait until 2023. But for us, we just don't see we don't have any visibility when this thing will happen, how steep and how fast. And also the second point, without the dividend yield and the net loss to persist, I think we just think that we're going to value this based on the price to book, since there's no earnings anyway. And if you take the global financial crisis average of 1.35, I mean, you can take 1.5 depending, but we just take the average, we get the 195 pricing. That's why we have a sell. Okay, and just to give you a reminder how steep the fall. I mean, basically zero. I mean, you can see the SIA passenger carried, I think like 18,000 something. Now you can just assume zero. Obviously, you can hold this stock for the next 2-3 years and wait for it to climb. But the next 1 year, I really have no clue whether this rebound, how sharp and how long will it take. Likewise, as you know, Changi airport activity is important for them. As I mentioned before, what SATS does is whenever the airplane lands, they will provide the food. They will also go in and clean the plane. So when the passenger traffic is down, the aircraft activity is down, obviously there's no business for the airlines part of the business. Okay, next, this is our usual weekly updates. Next. Okay, anyway, we'll start off with some of the macro data that's coming out from Singapore. Obviously, there's a lot. We just try to pick one of the more relevant ones. Exports was very strong. In June, our exports did very well. Most surprising was electronics export was up 22%. So that's a very good number. I think this is the second month of increase. And then, of course, like we mentioned, SIA passengers. Again, sorry, I have to say this again, but this is not a typo. So in June, they have 14,000 passengers. I'm not sure who they are anyway. But in the same time last year, they had 1.88 million. So you can see how sharp the decrease is, almost zero, I can assume. The other data point is the building materials. So ready-mix concrete, as you know, someone like Penn United or even Hong Leong, they ready-mix concrete, is the cement and so forth. And what we got was only 20,000 metric cube in May. You can assume zero, because like a year ago it was 1 million. You can see how sharp the decline. Basically, there's very little construction activity. I mean, you can't construct anything if there's no concrete. Okay, I need to move on to the next point, the US. The US retail sales number was positive, although it was down, but actually month on month, it was up 7%. So there's a second month of improvement. So I think the market was also rally a little bit on this news because the retail sales, at least in the US, things are rebounding. Okay, the big news is, of course, in Europe, you have this 750 billion EU recovery fund. And in this 750, although it's not written here, at least 400 over billion is grants. Basically, gift. You can say gift from the EU to all the countries that are suffering from the COVID. So this is very important. It's important. Well, of course, it helps perk up the whole global economy. Of course, it's also important for the EU, and also more meaningful is the first step towards fiscal union. It's basically the market will view it as all the 27 countries, the 27 EU countries, almost like sharing their liability. So this is very meaningful and probably can even help on the euro. Okay, but again, just for a broader market perspective, this is a very positive news if it gets approved. Okay, the other positive news, of course, the China GDP, I think you can see that, and the latest numbers also show that the industrial production in China is also improving. So anyway, in terms of our technical views, firstly, I think the global economy's recovery is still underway, despite the rise in COVID cases. I mean, of course, we all know in US especially, but we see that Europe and Chinese data from China is improving. The second thing is the big one will be the fiscal and monetary support. It's still going to be the key pillar for the rally. I think the first one, like we mentioned above, is the EU recovery fund. And the second one is the US Congress next stimulus package, which I will elaborate a bit more later. And of course, the other thing is that we think there will be some big economic headlines. I think the employment data looks quite bad. I mean, not bad. I mean, it seems to be slowing down. I think if you look at some of the Google numbers and so forth, it shows that the numbers could come down a bit. So we could see the market, the market might just slip a little bit because of this weaker economic headlines as the COVID spreads even further. Okay, in terms of weeks ahead, the big one, of course, will be the Congress stimulus package. I'll elaborate a bit later. And of course, we have our own Singapore data, GDP, and so forth. Okay, Okay, and in terms of our Poland's webinars, so the following are some of the webinars we'll be hosting with some of the listed companies. They're not in your poems yet, so just wait a little while because it takes time. We need the slides and everything from the company and so forth. So, but these are the listed company webinars that is coming up. So feel free to sign up if you have the time. Quickly run through some of the things. This is basically, we always nowadays, as you know, we have to do a COVID watch. So the blue line on the left is the world numbers. It continues to climb to record high. It's about 200,000 plus. The problem is the US line. It was the beige line. As you can see, it was initially sliding until somewhere in June, 12 June, 19 June, but it has started to rise to new record levels. But if you look at the other countries, the red line, which is like your China, Germany, UK, all these are still sliding. And on the table on the right, you can see, actually you can contain this, like we mentioned before. If you look at the red line in Italy, they used to have 5,000 cases, now dropped to 200. Please, just wear mask. Okay, anyway, next slide. Okay, and for back to Singapore, as you can see, we track this almost daily, and this is an important chart because this will determine whether, obviously, hopefully we don't go back to a tighter phase 1 or phase 2. And you can see the red line before the circuit breaker, the red line, this is a weekly average. We used to have 50 over cases a day, and that's the reason why we imposed a circuit breaker. It was 5, then now it's about 9. So we are holding well considering that we already lifted phase 2. So if this, it's just a guess. If it stays around this level below 10 and below, then hopefully the phase 2 will start to ease further. But in terms of phase 3, I think the minister has said it will be a long time coming. I'm not sure what that really means. But anyway, just the easing of the phase 2 restriction will also help. Next slide. Okay, again, we monitor this. This is just for reference. I'm not going to move down, but we just want to, will just show what is the activity. Is a daily number, so that's very good. So it shows that things are a bit stable, like moving sideways for Singapore in terms of, but again, just for your own reference. Next slide. Again, this is just for reference. It's not rising, so you're not seeing a sharp rebound. Things seem to be moving sideways. Okay, in terms of activity, recreation, workplace, and so forth. Okay, in terms of the numbers from exports, this is just a chart to show. You can see that the electronics exports is climbing up very strong. So obviously, this is good for all the electronic stocks. And also on the right-hand side, I think as you can see, if you just eyeball the red line means billings. That means actual activity, I can see. So you can see that based on the red line, the last time it was so low was probably 2011. So construction activity just collapsed. Obviously, with all the workers being contained and so forth. Okay, this is my last slide. Okay, so as you know, in March, the US came up with a 2.2 trillion package called the CARES Act. Very nice name, but anyway. Okay, so some of these parts of it is as you can see, the first column, the unemployment benefit. What happens, just for everyone's information, so if you're not working, then in general, you'll be paid half of your weekly wages. But what the stimulus did was they added another $600, which is quite huge, and I wish I had it too. But anyway, they added like $600 per week for those who are unemployed. And this, of course, obviously a big number. But the problem is that it will end in July. So what will happen is that the next 2 weeks, the Congress will look through and see whether to extend. So most likely they might extend, and also just maybe those eligible will be lower. Then, of course, they also had, like what Singapore, they did give a one-off payment, 1,200 for adults, 500. But anyway, this is just for reference. But the main point is that the market will, whether it's pricey or not, really not clear. But at least the market it can help support the market if they extend it. So so the reason why they could extend is because both parties want it. Republicans, of course, Trump wanted his election is coming. The Democrats, of course, want it because they're always there to support social programs. And the reason why we think it will happen is because the COVID-19 is still raging and the economy is at risk if you don't. So the expectations, the numbers are all over, but the expectations is around a 1 trillion stimulus. And what we expect, it will just extend whatever, all these programs like PPP basic PPP is the best one, if you will help cover your payroll for 2.5 months. It's called a loan, but actually it's just a grant. That means just give you the money outright. Okay, I'll move on back to Mthly. That's my last slide.
Sorry for the prior disruption. I'll start over. So I was saying that we are initiating on Manulife with a buy, and a little bit of background on Manulife is that it was listed in May of 2016 with 3 assets in their IPO portfolio. And over the years, they have acquired 6 more assets. So the current asset count stands at 9 with a total AUM of $2.1 billion. So we like Manulife for 3 reasons. First of all, is the favorable portfolio attributes, which will provide income visibility as well as growth embedded into the portfolio. Current valuations are attractive at 0.88 times price to NAV is near the -2 standard deviation level. And yield spread of 3.28% is at the positive 1 standard deviation level. So these metrics are attractive to us. And lastly, we see continued relevance and demand for office space. And we think that the demand for office will moderate and not abate. So on the chart on the right actually shows you the breakdown of Manulife's asset valuation by asset. So it's actually relatively nicely distributed. So on our first point, some of the portfolio attributes we like are the high occupancy of 96.5%, long WALE of 5.7 years, and built-in rental escalations. So 96% of their leases, 95.6% of leases actually have a built-in rental escalation, and this averages out to about 2% per annum. And also because of the long WALEs, expiries in the near term are actually relatively low. If you can see from our graph on the right, the expiries in FY20 is 4.4% by GRI, and for FY21 is 6.4% by GRI. So I think this is positive, especially given the economic uncertainty, which is putting downward pressure on business formations as well as leasing. Last of all, worth mentioning is that Manulife has a relatively high tenant retention of 76% in FY19. We'll move on. So for on to our second point, which is the attractive valuations. I think these 2 charts are self-explanatory. Chart on the left shows you the historical price to NAV. As mentioned, is currently trading close to the -2 standard deviation level. And the graph on the right shows us Manulife's historical yield spread, and is now trading close to the +1 standard deviation level. Even though the price to NAV currently is very low, we think that the high collectibility of rents, this is also largely due to the kind of tenants that are in Manulife's portfolio, which are largely finance and legal tenants. 22.2% and 20.2% of them are legal and financial tenants, respectively. And also a lot of the tenants actually utilize the space for HQ locations. So there's more collectibility of rents, and also owing to the fact that Manulife only has allowed 2% of rental deferments in the month of April, and collections for May and June are on track. So another thing is that we think that the asset valuations for the office assets will be relatively stable in terms of delinquent collateralized mortgage-backed securities. If you compare the lodging, retail, and office assets, the delinquencies for lodging and retail assets were 22% and 17%, but for office buildings, the delinquencies were only 2.2%. So this is why we think that asset valuations are going to be relatively stable and resilient for the office sector. The last part is that the long WALEs that is prevalent in the US office market will provide support for the leasing demand. So the graph on the right actually shows you the distribution, the lease distribution of office leases. So actually the majority of it are longer than 8 years, as you can see. Yeah. So this will help to provide some near-term support for rents. The third reason is the continued relevance and demand for office space. So the top 3 leasing drivers for office is the tech, financial, and professional service industries, and these tenants have a predisposition for the office workplace setting. So I think previously mentioned by Jie Hui is that the financial and professional services especially have a very long track record in the market, and these players or these industries are the ones that still see the value of the office work setting, and they are still the ones that are primarily leasing drivers. Second of all, of course, the physical interactions are viewed as one of the most effective modes for mentoring, collaboration, and innovation, and this speaks to the continued relevance of office space. And also, a work trend study shows that that physical face-to-face modes of collaboration are as valued as virtual collaborations. The chart on the right just shows you our Manulife's GRI breakdown by trade sector. And as you can see, largely the biggest component is actually legal at 22.2%, followed by finance and insurance at 20.2%. So the work trend study was actually conducted by Gensler's US Workplace Survey, and it was held from 2013 to 2019. Over the years, while the working alone has actually the percentage of time workers spend or employees spend working alone has fallen, and collaboration has actually increased. So while virtual collaboration has increased from 7 to 14%, collaborating in person has also increased by almost double. So, and this is without the stress and the containment measures, social distancing imposed by COVID-19, and we can see that barring these containment measures, that the trend is towards collaborating, and also the fact that both of these collaboration methods are increasing in tandem shows that they're both equally valued, and hence, the physical kind of connection cannot be replaced. So I believe this is the last slide for me. So I just want to briefly highlight the key risks, which are higher than expected adoption of remote working, and as well as weaker than expected leasing environment and change in tax regulations, which may affect the tax exemptions that Manulife's currently relatively efficient tax structure provides. So once again, I think I'll wrap things up by saying that we're actually initiating to buy. The target price is 80 cents. And at this current entry price, the yield for FY20 is estimated at 8.8%, and FY21 is 9%. So thank you. I think I'll move on to the REIT monthly. So just taking stock of how things look right now, the REIT index is currently outperforming the STI. Next. In terms of recovery, still pretty much looks the same. Industrial has recovered most of their share price, and the laggard is still hospitality. In terms of dividend yield spread, we are still doing better than last year. Currently still around the mean, which is at positive 0.19 standard deviation level. There's not much data coming out for the real estate sector for the month. So we only have the retail as well as the hospitality data. So for the retail sector, this is the retail sales index, and it is still currently negative by year-on-year is down by 46%, and of course weighed down by trade sectors like discretionary trade sectors like departmental store, fashion, jewelry. Of course, this is for the month of May, which is when the circuit breaker was in effect. And in terms of F&B index, it also still negative, down by about 50%. Paul briefly touched upon this, so I won't linger too long. International visitor arrivals down almost by 100%. RevPAR also down, but has recovered very slightly in the month of May. So the trade sector, the accommodation sector that actually improved the most was upscale. It's actually by 12.2 percentage points, not 2.2. So it's a little typo here. And this compares to the rest of the sectors: luxury, mid-tier, and economy, which only showed RevPAR improvements of about 2 to 3 percentage points. So what we notice is that the reason for the improvement in the upscale segment's RevPAR was the lowering of the room rate. So it was slashed by almost 70% year on year. And this is the deepest discount across the segments. So they managed to double the occupancy for the month of May by reducing room rates. So, and we think that this improvement in performance for the upscale tier is actually largely due to COVID-related business. Like block bookings by the government for the stay-home notice. One positive news for the hospitality sector is that hotels can apply to reopen for staycation bookings from the 3rd of July. And while there's pent-up demand for travel and nowhere to go, this actually can help hoteliers in the near term. But we also do expect hoteliers to provide significant discounts to achieve the sweet spot. The next page will show you our calls for the REIT sector. And so I think this brings us to the end of the presentation, and we'll take Q&A right now.
Yeah, I'll start off with the Q&A. I think there's 2 questions for Hyphens right now. One is saying that it's trading at 47 cents, one is trading at 48 cents, and my target price is 43.5 cents. So whether it is currently being overvalued right now. Okay, so I think for Hyphens itself, what we are pricing in is the organic growth of the company. But as we've seen, if you want to compare it previously in 2016 when they actually acquired Ocean Health and achieved an additional sales channel for themselves, you can see that their business actually grew by quite significantly. So what happens now moving forward is that actually the company itself is also constantly looking for this kind of inorganic. So right now, what the company is doing is that they are constantly looking for inorganic growth by acquiring other brands or even other possible sales channels so that they can sell through. So without any, however, from our side, of course, we do not know whether there are any potential plans, but if these kind of plans do happen, it will be a very strong expansion possibility for Hyphens Pharma, because right now what they have in the market, especially for the retail side, is still a very small portion. If they are able to increase their retail sales by a lot, then this will become much more. It'll become much more. It'll be a very strong, bullish, strong factor for them. Yeah, sorry.
Okay, I'll take some of the questions. Philip's target price for SATS at 195 seems much lower than other analysts. Why so? And also, I'll just relate to that. It's a second question. If no visibility, how do you arrive at the target price of 198? Our target price is based on price to book. In terms of why we use it and why we had to sell and why our target price so low, I think the key reason for us was because we actually do not know why we want to even buy or hold. We can't really justify. I mean, if someone were to ask us like why hold it, then we can't. There's no dividend yield, and then we have no idea how long this thing could take to recover. The next 1 year or even 2 years. So that's the reason. I mean, that's the main reason why we have a sell, because we really can't justify why you keep a hold and even, of course, not even to buy it. And the other reason, in terms of the target price, because there is no earnings, and likely this year and even next year, the earnings will also be depressed. So we just took target price is probably the obvious, less earnings dependent. Even if we do a DCF also, there's so much uncertainty for the next 2 or 3 years, the earnings. And we took global, there's no science to it. I mean, like, why take global financial crisis? Why not take other periods? Because we thought that was the last time when the SATS or the airlines faced such a depressed demand conditions. And we took an average as a reference for the reference for the book price to book. Yeah, I hope that helps. But ultimately, it's more of a reverse question. I mean, why should I hold this stock when I don't know when it's recovering? So long as we couldn't answer that, we thought the better. If we can't justify a buy or hold, we just put it as a sell. I mean, that's the conclusion of it. But thanks for the question. Okay, we also have another question. Paul, can you comment on the Sabana ESR marriage? Any view whether this is a positive? Okay, this is my own view. I mean, we don't cover. I don't have a long coverage on it, but I just find even after this acquisition, the actual yield for Sabana, it will normalize because they're only declaring 0.4 cents, 0.43 cents for first half. So even if let's say you analyze it, first half, let's give them 1 cent. So you know the yield, if you think that is probably like 3%, and in their slides they put dividend unit per share or it's about 2.68. And even that I think you get like maybe 5% yield or something around there, or 6% yield. And that 2 point something cents yield that they are claiming is like, it's like using the beauty app kind of beauty app yield, in the sense that it's like with a lot of makeup on it. So that how they get the yield is that they assume they pay in units, but they actually pay in cash. They assume they got interest cost savings. There's a lot of assumptions in there. So, and even at 2.6 something, 2.68, I think 2.63 dividend yield, the yield is 6 to 7%. Whereas if you compare to some of these US office REITs, they're paying 8% yield. And I mean, I'm just saying this in jest. I mean, their assets are leased. Their assets are 30-year or maybe 60-year leases, whereas the US office are freehold. The units are. I'm just saying just this is in Ang Mo Kio, in Ubi. These are in Los Angeles and Houston. So I mean, if you want to compare against the office REITs, I think there seems to be a clear winner that the office REITs stand up better than some of these. Some of these industrial REITs. I mean, that's my own general comment. I'm not this part in jest, I guess. Yeah. Thanks for the question.
On the chat, there's also a question about Hyphens on whether I will change my target price. So, like I was mentioning, some of the reviews. Okay, the factor that will cause a revision in target prices will be if there are more visibility, if there are any like expansion of the company, whether they're acquiring some other companies or some other smaller brands. So these will be a revision factor. So right now we do not have visibility on them yet. As such, we won't be changing our target price for now. It will still remain as a call at 43.5 cents. Thank you.
I'll take some questions. I think there's one question about what's the view regarding the CAD probe on EC World. So from our understanding, this is a probe into an individual and not with respect to the REIT or the REIT manager. So in essence, basically, we don't think that this there is any misdealings on the part of the REIT. Any comments for Escort? So I believe Escort actually issued a profit warning last week, and in their profit warning announcement, they actually expected the total return for 1H to fall by about 80 to 90%. But also due to some very relatively handsome fair value gains in the first half of 2019, where they actually realized the gain of Escort Raffles Place. I think that also helps to skew it, and hence also the very alarming drop in terms of revenue. Yeah, so for Escort, well, we are aware that actually about 18 of their properties still remain closed. I think that's about all the info that we have. I think the also another point to note is that while there is some closures, most of these closures actually are in assets which are on master lease or management contract with minimum guaranteed income. So that's the bulk of it. And from what we know, Escort has not actually offered any kind of rental rebate or waivers or forgiveness for rents. Yeah, that's all.
I think there's a question on SGX and Capital Land, so I'll take the SGX part. For SGX itself, we already have the latest kind of guided, because of SGX actually published their monthly business overview on SGX itself. So we actually kind of have an insight to how they will likely do for this coming quarter ended June. So what we see is that they most likely will be comparable to last year's results, maybe overperformed by about 5%. We still see that in terms of equity market itself is still enjoying quite robust SDAV, growing double digits, I think 20 to 30% year on year. However, for the derivative side, we are seeing a slowdown, although there is a recovery over the course of April and May. So April and May actually fell by quite a bit, like 20%, but year on year, but then it has recovered from the lows. Right now, it should, and if you are thinking of going forward, what will be the thing that differentiates them is that many people sold them down because of the cessation of the MSCI contract. Right now, they are actually coming out with replacement products with FTSE, and which will replace the largest contract that they are losing from MSCI, which is their Taiwan derivatives, their Taiwan index futures. So that will be a main good thing for them, moving forward. For Capital Land, I'll maybe ask Mthly to answer that part. Then I think I'll just continue taking on first. For Hyphens, continuing from Hyphens Pharma, I think there's a question on whether a pharmaceutical company like Hyphens will be weaker when compared to US pharmaceutical companies, solely because Hyphens do not really research vaccines. Of course, right now we see that a lot of the resources are diverted to come up with vaccines, but ultimately this is a very short-term play, maybe until end of the year. Right now, a lot of companies are already entering. Some of the companies, sorry, not all, a lot. Some of them are actually entering the clinical trials for mass production. So of course, with more choices in the market, it will be better. But eventually, this is I think there will be some consolidation once the whole thing blows over. There is still an innate, very strong demand for medical and healthcare products and services in the long run, beyond the current pandemic. So if you are looking at investing into the healthcare sector, you can't just look at the short-term pandemic. Of course, currently right now, all resources, like I said, all resources are diverted there. Then there's also one question on any comments on the 3 Singapore banks. For the 3 Singapore banks right now, really, they will be announcing their results on the second week of August, right before the National Day holidays. So I'm keeping a lookout for those results. However, from what we see in the US, if we take some guidance from the US banks, although it's not, their business model is quite different. We see that actually a lot of the US banks, they enjoyed very high trading volumes, which boosted their trading income in the past quarter. For local banks, definitely it will also help them, but we know that for local banks, the trading volume don't take up as much component of the income. Of course, it will offset some of the net interest margins pressures. But in a short run, I think that for this past quarter and for the next quarter, I don't think there will be much changes to the top line. Maybe the bottom line, we will need to see how much they are actually catering for their allowances before we can make any judgment on the outlook for the Singapore bank. But personally, I feel that the 3 Singapore banks still provide a lot of value for investors, especially for the dividend, and which are not likely to be cut, at least for this quarter. So all 3 banks will be giving out dividends, will be announcing dividends for this quarter. So yeah, sorry for all the. I think there are a few questions on TA because Wei Ren actually has a session at I think 1 or 1:30, so that he has already left this webinar. So if anything, you all can tune in to his session to ask him about the TA questions. So right now we can't answer this. I'm so sorry about it. Our specialist is not here.
Hi, I'll take some questions too. So I think one of the questions was a clarification. Someone said that I said that there's strong demand for physical office space. I think if I said that, actually I meant that there is a resilient, not strong, but resilient demand for office space. So, one of the reasons is that so back to the question. I think for our thesis on the US office sector, we actually do believe that in terms of demands and leasing demand, it will be weaker, and we both Jie Hui and I, in our respective models, we actually have also projected for vacancy rates to actually go up. And but that being said, right, I think the clarification here comes from we think that the demand for office will moderate, meaning it will slowly be less strong, less excessive, but it will not fall off the cliff and abate. So that's the clarification. Yeah. There's also several questions here asking us which is better of the two, Prime, Manulife, and some have even included Keppel Pacific Oak, which is also a US office REIT that actually they own slightly different assets from Manulife and Prime. So in terms of Manulife and Prime, these two REITs have very similar kind of portfolio attributes and portfolio qualities and asset qualities. Manulife and Prime, they hold primarily core office assets, meaning more of the Class A and B assets, whereas Keppel Pacific Oak, I think the locations of these assets are slightly different as well. They are more of the up and coming cities and not really the core and spoke kind of assets. So that in terms of asset quality, there's a slight difference. So I think, second of all, if you're comparing just between Manulife and Prime, as I mentioned, the portfolio metrics and the asset quality is actually relatively similar. We have summarized some of these metrics in our report. I believe it's on page 7. So I'll just briefly touch on them. For example, in terms of number of properties, Manulife has 9, Prime has 12. In terms of WALE, Manulife's WALE is slightly longer than Prime's, 5.7 years versus 4.9 years. In terms of gearing, Manulife's gearing is slightly higher, 37.7 versus 33.7. So I think that there are very, very subtle differences. Manulife does have a longer listing history compared to Prime. I believe that currently in terms of yields, Prime's yield is slightly higher than Manulife's yields. I think that also owing to the inclusion into the REIT, Manulife has also benefited from some price appreciation and cap rate compression. Yield compressions. So in terms of this catalyst into the entry into the REIT, of course, this is a catalyst that is still available to Prime, but Manulife has already captured that. I think the short answer to this question is that we like them both. In terms of yield, I think Prime is the one with the slightly higher yield at 24% total return versus Prime's yield of, rather forecasted yield of 22.4%. Yeah.
A question. I think just a question on whether I think DBS second quarter dividends will be reduced. I think for this upcoming first half dividends for UOB and OCBC, as well as the quarterly dividend for DBS, most likely there shouldn't be any cuts. I don't think that there will be any cuts, but the main thing to look out for, because what I believe is that it will be sustainable in the short term, and I do not think that these 3 banks will make unnecessary adjustments unless they see an impact to their business itself. So it will be important more to look out for the outlook of how they are going to revise their dividend policy moving forward. Yeah, so that's more important. But in terms of cut directly this quarter, I doubt so. They will definitely give some guidance if they were going to cut, and we can definitely follow up from there. Yeah. I think there's also a question on the chat itself that says how to calculate total return for the REITs. Actually, for our calls, when we calculate total returns, it is always a result of the target price based on the last done price, the previous day last done, or last done price, plus the yield that we forecasted. So we can't really show any examples right now. So, but then yeah. So for example, if a target price is $1.10, but the stock price is $1, so it's a 10% capital gains. But then if they were paying a 6% yield, it will just be 10% plus 6%, it will be 16%. There's a question on the new IPO Singapore Pain Care Holdings. For this, we do not have any. I think haven't really taken a look at it yet. But they will be having an investor day, I think, on the 23rd. So this Thursday. Maybe if you like to know more, you can drop an email to us at research@cybercode.com.sg or any of our direct emails, and you can we will try to answer it after we have attended the meeting on 23rd. Yeah, thank you.
I'll answer there's a question on Netlink and Capital DC. I'll answer the portion on Capital DC, and Netpol answer the one on Netlink. For capital DC, our call is actually a neutral. Meaning to say that we do think that it's relatively expensive. But that being said, the share price has continued to rally despite against our expectations. So I think one of the reasons why we think that the share price is continuing to rise is that the yields are currently around 3-ish%. But if you compare to the US DC kind of assets, the yields they are way lower, around like about 2% to 3%. Yeah, so probably the Singapore market is trying to price these data center REITs similar to how the US ones are priced. And also, of course, I think there's a bit of euphoria or optimism with regard to data center assets because they are clearly one of the beneficiaries of this COVID-19 pandemic. Any comments on CapitaLand Mall Trust or Fraser Centrepoint Trust? Our call on these two counters are accumulate. And I think this is also, I can answer this question together with another question regarding how the rising unemployment in Singapore will have an impact on the local retail REITs. So I'll take these two questions together. For Fraser Centrepoint Trust, of course, this is our preferred call in the retail REITs segment. One of the reasons because of the organic growth due to the increased catchment size due to the catchment size that will increase around the three largest malls, your North Point, as well as Causeway Point and Waterway Point. Second of all, the inorganic growth catalyst. So, just last month itself, Fraser Centrepoint Trust acquired the remaining 12% stake in this private retail fund, which is called PGIM. The intention is obviously has always been to actually for FCT to acquire some of these assets from PGIM. These assets have a similar kind of quality as those assets in FCT. So for CMT, we also have accumulate, and I think that basically just means that we think that fundamentally CMT and FCT should the intrinsic value is higher than the market. And I think for the most part, most of there's a little bit more visibility in terms of incomes because most of the rental rebates, etc., have been announced, and more or less the situation the dust has settled and there's more clarity on the situation. So we think that probably by way of rental rebates or income disruption, it will be more or less minimal from now on. Oh, sorry. For the question on how unemployment will affect retail REITs, I think this is a bit hard to say. So while there's an interlink, obviously, consumer sentiment will impact spending as well as the survivability of these tenants within the retail REIT portfolios. Ultimately, the performance of the retail REITs will depend on the receivability of the rents from their tenants. So I think that it's no secret here. We actually do expect some sort of weakening of, or rather softening of the leasing environment and vacancy rates to go up. And this has also been forecasted in our valuations. I'm sorry, I'll take another question. For Escort Trust, in the past webinars, I believe it was mentioned that average occupancy rates remain comparatively high at approximately 60% due to long lease stays. This seems to be inconsistent with the current deep profit warning. Why is this so? So, yes, that is right. That I think I did mention this in the previous webinars before, that the occupancy, because of the service residences that are predominantly in Escort Residence Trust's portfolio, these service residences have a component of long stays, and that has helped the service residents to outperform their hotel counterparts. So of course that means that there have been some closures. 18 Escort's closed. 18 assets within the Escort portfolio are closed. And not to mention that this 60%, although it is less bleak compared to hotel occupancies, it is still significantly, I think about 20% down from the kind of occupancies that Escort used to see. So I think that does warrant some sort of decline in revenue, and also hence the profit warning. And I think also mentioned that as compared to the same period last year, where Escort actually recognized a very handsome gain on disposal of their Escort Raffles Place asset, that will also lead to even more alarming drop in the revenues. So I think that should answer the question.
I think there's a question on the chat. Sorry, for the target price for REIT is to be achieved over what time frame? For all our target prices, we take on an approach of the next 1 year. So yeah.
Okay. We still have some questions. Let me just try to answer some of them. For you, UMS still can buy at this price. We don't cover, but I think you buy UMS, you're basically buying into applied materials, and applied materials already guided that they are expecting strong double-digit growth in FY20. So this year will be, again, we don't cover, so I can't tell you the target price, neither can I say the valuations, but their major customer, I think that's their key customer, already guiding for very strong double-digit growth in FY20. So I guess, I hope that then helps you. So it looks okay for this year. On Semcom Industries, we really dropped coverage. You send us an email. Let me get back to you because I didn't really look closely at the recent results. So a bit unfair for me to comment and kind of give a wrong answer. So I need time to digest their recent results. In terms of, okay, then there was a question again on, is net link too high to accumulate now? Our target price is 103, but I do understand, as you know, this stock will be slow growth. I mean, even when the results come out, it's probably like a yawn. I mean, it's like nothing major to be expected, and it will just be very slow-paced growth, which is what you want because you want the yield. So you can always wait for this stock. You can always just queue at a bit lower, 1 or 2 bits lower, because there's no rush. The earnings momentum not going to just spike up. But of course, our target price 103. So even at these levels, it is still fine. It is still fine because it's like they're paying you like 5% plus kind of dividend yield. Any updates on Star? I think we don't cover Star Hill Global, but the one important thing about Star Hill Global is because their year end I think is June, so it will be a quite important barometer because that's where they're going to have to value their retail assets. So it will be interesting to see how they're valuing their Orchard assets, and that valuation can impact the rest of the, at least knee jerk because maybe they value it down now, then they might value it back up now. But I guess the importance for Star Hill is just the valuation of their retail assets. Like even for Sabana, their valuations got hit 5 percentage points. That's because the valuers now assume vacancy rates will be lower. Which rightly so. I mean, in the past they were a bit more optimistic. I mean, whether rightly or wrongly, but I guess if there could be some risk on some of the valuations. I mean, if there's a broad-based assumption that vacancy rates will remain quite high by the valuers.
There's still a question on whether the banks are too high to accumulate now. I think right now, like I said, for this quarter, I still think that the banks are trading quite attractively, especially for their yield. But that's why the forward guidance will be very important. Right now, personally, I feel that it is still a good time to accumulate the bank because the banks will always react to the recovery, and we must know that the current prices for banking stocks itself is already taking into account the expectations that we are going to have a downturn for maybe a longer period of time. But once we see signs of recovery, I think that's when the banks will start to recover as well on prices.
But SGX will be like I think Biko mentioned, SGX look interesting in that sense because there could be some fallout from the whole Hong Kong episode. Because the whole MSCI is moving to Hong Kong, and then MSCI is a US product. I mean, we don't want to speculate here, but there could be issues of issuing any MSCI product with tensions rising so high between US and China. And if there's any stalling of the MSCI, which is the main product is the MSCI China, then it could actually help SGX, at least come and help re-rate the SGX or the derivatives Of course, not for the cash market, the stock market, since there's hardly any IPOs. Like Hong Kong, like 5 to 6 IPOs a day. Ours like 5 to 6 IPOs a year, maybe. Yeah. Okay, if there are no other questions, I think we have to end it because thank you everyone for attending, and of course for all your questions. Do email us. There's a group chat, or even better, if you go to the Stocks BNB website, the community page, and ask the question. Because Viren's event will be starting at 1 p.m. So we try not to interrupt his. Okay, thank you everyone for attending, and thanks for your questions. Thanks again. Bye bye.